So 2 years ago, global ETF actually surpassed passive mutual fund in terms of their asset under management. And since the creation of ETF 30 years ago, we're now seeing a more distinct shift of investors moving into ETF in recent years. And this is not really surprising as ETF really offers some key advantage over active mutual funds and unit trusts. For one, over the past few decades, most active mutual funds have actually failed to beat their benchmark, showing us that passive investing might actually be more appropriate for investors. And secondly, because of passive ETF does not require a large team of fund managers to manage the investment, many have been able to bring down their yearly expense ratio compared to identical mutual funds. Of course, all funds, be it mutual funds or ETF, will have an annual fee. And this will be deducted from your invested capital, meaning that we don't really have to pay extra for staying invested in either ETF or mutual fund. And as ETF are also traded like stocks on the stock exchange, you can basically buy and sell them anytime through your brokerage account. So today, let's take a look into some of the lowest cost ETF in the market across different strategy. Number one, the S&P 500 index. The most common ETF is funds tracking the S&P 500 index. This is the most widely followed stock index in the world, tracking the stock performance of 500 of the largest companies listed on the US market. This will include common names like Apple, Microsoft, Tesla, Johnson & Johnson, Visa, and many more. Of course, there are many ETF in the market that tracks this index, and many of them are among the lowest cost ETF in the world. But out of all of them, the lowest cost of them all is the SPDR Portfolio S&P 500 ETF. This ETF is issued by State Street, one of the largest fund houses in the world. At the moment, the top 5 holdings of the ETF include stocks like Apple, Microsoft, Amazon, Nvidia, and Alphabet Inc. This ETF has been issued since 2005 and right now has an AUM of around $19 billion. And it only has an expense ratio of 0.02% a year. This means that if you invest, say, $1 million in this ETF, the ETF will charge just $200 a year from your invested capital as expenses. And that is a pretty good deal to track the performance of some of the best companies in the world. Number two, emerging markets. Most ETF are still very US-centric, given that the US market is the largest ETF market by magnitude compared to the rest of the world. However, there are still some very large ETF that focus on international market, such as the emerging markets. So if you believe in the rise of emerging market, maybe in particular markets like India and China, then looking at an emerging market ETF might suit you. And in this segment, one of the lowest cost ETF available is the Vanguard FTSE Emerging Market ETF. And this is issued by Vanguard, the mega fund houses that always advocating passive investing. And the ETF objective is to track the return of the FTSE Emerging Market All Cap China A Inclusion Index. This means that the ETF will invest in stocks across key emerging markets like China, Brazil, and India. The fund now owns around 5,700 stocks, and among the top holdings includes names like TSMC, Tencent Holding, Alibaba Group, and Reliance Industry. The fund is issued in 2005 and now has an AUM of around $73 billion. And it also only has an expense ratio of 0.08%. And of course, to put that into perspective, $1 million invested in this ETF will only cost you $800 from your invested capital a year. Next, bonds. The bond market is actually significantly larger than the equity market. And with the high interest rate environment now, bonds are becoming more attractive than before. And due to the large minimum capital needed to invest in bonds, using a bond ETF might actually be a good way for us to gain exposure to this asset class. And in this front, one of the lowest cost bond ETF is the iShare Core US Aggregate Bond ETF. iShare is actually an ETF division of BlackRock, one of the largest fund houses in the world. And the ETF goal is to track the performance of the Bloomberg US Aggregate Bond Index. And it will match the objective by investing in US investment grade bonds, mainly in US Treasury notes. The average weighted maturity for this ETF right now is around 9 years, and the yield is giving us around 4% right now. The fund actually originated in 2003 and right now has an AUM of around $92 billion. Its net expense ratio is just 0.03%. Again, meaning that $1 million invested in this ETF will cost you $300 a year in fee. So there you have it, 3 of the lowest cost ETF across key strategies. The Spider Portfolio S&P 500 ETF offers you access to 500 of the best companies in the US. The Vanguard FTSE Emerging Market ETF will let us invest in key emerging markets like India and China with a very minimal fee. And lastly, the iShare Core US Aggregate Bond ETF let us tag on to the US bond market and enjoy its high yield at the moment. So if you have gotten value from this video, I hope you give us a like and share it with a friend who you might think will benefit from it as well. Anyway, as always, my name is Stanley. Please note that all content provided is just for educational purposes only and not investment advice. Until we meet again, invest safely.